As the market becomes obsessed with everything artificial intelligence and technology, I think there's a lot of companies that are being really overlooked. Very low price to earnings multiple, really solid growth numbers, just solid brands being built. And one of those that I think investors need to pay more attention to is Crocs. If you look at Crocs over the past few years, this is a company that maybe doesn't get the same attention as a lot of other brands, but it's actually solidly growing that core Crocs brand. There's a turnaround underway for HeyDude, which is the brand that the company acquired a couple of years ago. Been some struggles at that brand, but the business overall generating solid free cash flow, paying down debt, potentially buying back a significant amount of stock in 2024. And with all the tailwinds behind the company and the potential turnaround for HeyDude, I think this is a very attractive stock right now. So I want to dig into some of the numbers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's first look at Crocs overall, because when you look at the revenue and gross profit numbers, this is just an incredibly impressive company. $4 billion in revenue, gross profit in excess of 50%. So $2.26 billion in gross profit in the last 12 months. And if we look over at net income and free cash flow, about $800 million per year in free cash flow. And that's been consistent over the last couple of years. There's of course going to be ups and downs over time, but the company has the right strategy now with Crocs. Now it's transitioning to using a similar strategy with HeyDude. That has taken a little bit of a transition, but I think the Crocs brand itself has much more staying power than a lot of us, including myself, would have thought a few years ago. So let's break down that Crocs brand specifically. If you look at Crocs revenue and operating income, revenue has more than doubled since 2020. Now $3.1 billion in revenue on a trailing 12-month basis and $1.1 billion in operating income just for the Crocs brand. HeyDude, a little bit different story, doesn't have the same consistent growth. In fact, you can see here that revenue has been on the decline recently. There are a couple of reasons for that. One is changes that they've made to their distribution partnerships. They're going to have fewer stores that they're going to be in. The hope is that they're going to have less discounting, have a little bit better margins for HeyDude, and not have quite so much volatility in the business. The short-term impact has been less product going into the channel. So that's why revenue has dropped as much as it has over the last couple of quarters, but management thinks that will turn around later in 2024. I'll get to those numbers in just a little bit, but you can see that margins were really low for the HeyDude brand. So that's kind of a drag on the company. You think about the stock overall, you're analyzing both Crocs and HeyDude. Well, that Crocs brand growing double digits, 16% in the first quarter, really high margins, very profitable. That would maybe warrant a higher multiple than the stock is getting right now, but you add the HeyDude brand in there, it kind of pulls things back. So if the narrative changes for HeyDude over the next year or two, that could really help the stock and the perception of Crocs. But right now, just look at the fundamental performance. I think the company overall is doing extremely well. Now I'm going to get to the debt picture in just a minute, but I want to go to what management said things looked like in the first quarter and put some context to what we should expect when second quarter results come out. And that's only about a month or so away. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So here you can see some of that detail. Crocs brand in the first quarter grew 16%, just a phenomenal growth rate. Direct to consumer was actually leading the way, up 19%, and wholesale up 14%. HeyDude was really a drag on results, negative 17% from a revenue perspective. But you can see much smaller business, about a quarter of the size of the Crocs brand. And over the next quarter and the full year, a lot of these trends are expected to continue. So you can see that Crocs revenue growth expected to be 7 to 9%. Now, management has kind of sandbagged these results the past few quarters, so wouldn't be surprised to see if this is going to be a little bit better than that. HeyDude expected to drop 17 to 19%, but then improving for the full fiscal year to down 8 to 10%. So that means the second half of the year is going to look significantly better. Results will be essentially flat. So if they can outperform that, then it's very possible that this revenue growth number for the full year is better than 3 to 5%, which is what management is expecting. Earnings per share, 12 and a quarter to 12.73. As I'm recording, shares are trading for about $155 per share. So that multiple is only about 12 times. So that's not bad, especially when you look at the vast majority of the business is this Crocs brand, which is growing at nearly double digits. So a very solid growth rate for a company that you're getting for low double digits price to earnings multiple. So I think Crocs is a really solid business, solid free cash flow generator. And until the brand just simply goes out of style, which for some reason I don't think is going to happen anytime soon, this is just going to be a cash generating machine. And so what is management doing with that cash? That's really the question for investors. And there's really two things that they're doing with it. You can see with this chart, they have been paying down debt that was primarily associated with buying the HeyDude brand. There was nearly $3 billion worth of debt in the March 2022 quarter. 2 years later, that was down to about $1.7 billion worth of debt. And you could see in that, some of those charts earlier that financials have gotten much better over that period of time. But the other thing they're doing with debt is buying back stock. And the buybacks are a little bit lumpy, but you can see over the past few years, about $1 billion worth of share buybacks. The share count is down about 6%. And what management has said is that now they're at a comfortable level from a debt perspective. They're going to be buying back more stock. And so buying back shares of stock when your stock is trading for 10, 11, 12 times earning, that's a pretty good use of capital because the cash flow yield of those buybacks, the earnings yield of the stock that you're buying back, is going to be in the high single digits. So I think that's a good use of capital, especially if the core Crocs brand continues to grow and HeyDude has any sort of turnaround in the back half of 2024. So a couple of things really going for Crocs right now. One, I think the foundation of the business is just much more solid than I would have expected 5 or 10 years ago. Crocs doesn't seem to be going anywhere. They have shelf space in some of the best retail locations. Their own stores are doing really well. So that's a solid foundation from which to build on. The financials, as a result, are also really solid. So the core is growing at a high single digit rate. And if that continues for any period of time, this is going to be a phenomenal investment. The second thing is the HeyDude brand. If management can really turn that around and do some of the things that they did with Crocs a few years ago to improve both growth rate, margins, and the profitability of the HeyDude brand, that could be a tremendous tailwind for the Crocs brand. So that's maybe kind of more on the optionality side, but that's where if you're paying a really low multiple and you get that optionality upside from a turnaround in HeyDude, that's the kind of options that I want as an investor. And the third thing, what they're doing with their cash, and like I said, about $800 million worth of cash coming into the business right now. They're paying down debt, may not be doing that quite as aggressively over the next couple of years, but they are going to be now starting to buy back more stock. And those buybacks means that earnings per share are going to go up. And so if earnings for the business overall goes up and the share count goes down, that's going to juice the earnings that you're going to earn on a per share basis as an investor. So all positive trends. I think the biggest thing that could provide upside is the turnaround at HeyDude because it looks like Crocs itself, the Crocs brand, is doing extremely well. But what do you think about Crocs? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.